Good afternoon, ladies and gentlemen, and welcome to the Trinity Exploration Production half-year results for the period ended 30th of June 2020. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted on the right-hand side of your screen. The company may not be in a position to answer every question it receives today, but we'll review all questions submitted and answer where appropriate to do so. These will be available via your Investor Meet Company dashboard. I'd also like to remind you that this presentation is being recorded. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Bruce Dingwall, Chairman, and Jeremy Brigler-Singh, apologies Jeremy, CFO from Trinity Exploration Production PLC. Good afternoon.
Thanks, Paul, and thanks everybody for joining us today, and I hope you're all well and fit, as are your families and colleagues. We've got a fair bit to get through. I think it'll take about 35-40 minutes and then obviously open up for questions. But I think the interims as presented, and Jeremy will do the financials, and I'll come back on towards the end and do new business, etc. Point to a company in very good shape. And as I've said many times before, this isn't by luck, this is by design. From the restructuring that we went through 5 or 6 years ago, we have a set of policies and procedures in place and an ethos in place that takes our business forward, always very wary of the bottom line and of cash. And I think, as Jeremy will go on to demonstrate, our balance sheet is extremely strong in a backdrop where companies are having a really hard time across the market. And our capabilities we're building internally, and as we'll go on to demonstrate, our core abilities to transition and automate are very important. And in the back of that, our innovation around automation, but also our knowledge on the ground, not only in how the system works, as it were, in regulator and the regulatory authorities, but also our operating experience on the ground, our automation experience on the ground, our understanding of reservoirs and regional geology has put us in a very good place with some business that is now live. And I think you'll see that we're talking more openly about new business, and also within our own business beginning to lay some timelines down, particularly on the TGAL/Echo platform development off the East Coast. So we're about scaling this business now, making this business relevant to the stock market through innovation, from the basis of our core strengths and our balance sheet, and creating partnerships that build new businesses and create new business. That's the real value. So without more ado, I will go on and let Jeremy go through the front half, and I'll pick it up after that. Thanks, Jeremy.
Thanks very much, Bruce. Thanks everyone for joining us today and taking some time out of what is a set of unusual circumstances to hear about Trinity and what's happening. Bruce, do you mind shifting to slide 4? I don't seem to have control of these slides at the moment.
Got it.
Thank you. Great. So our results here, in typical fashion, we speak about the core of the business, the production, and then the P&L. On the next slide, we'll talk a little bit more about the P&L and then get to the balance sheet. And then we'll talk about automation before I hand back over to Bruce. So production up 9% when you look at half 1 of 2019 compared to 2020. Also in terms of half 2, 2019 compared to 2020. The production growth is on the back of the drilling program that we did in 2019. We drilled 6 wells there, inclusive of the high angle well. All of these wells, inclusive of the high angle well, were quite encouraging, and production built coming into Q4 and then into Q1 of 2020 and onwards. And right in the sort of the end of Q1 is where we had this challenge with the virus and the pandemic kicking in. And so sort of around the middle of March is when Trinidad actually registered its first case on March 13th, I think. And that changed a lot of things. It changed the way in which we work, certainly from an administrative perspective. The offices now are, the offices are a skeleton crew. So the guys on the field had to continue going in every day, had to continue exposing themselves to potential risks with not only amongst themselves, but also with external contractors and suppliers. So there was a lot of discussion, a lot of dialogue between the operating team and management. And we managed to work together to put together a set of protocols very quickly that offered the guys on the field comfort that them coming out every day that their level of risks would have been mitigated to a significant element, and they continue to come out. And as you can see, our production has held up and grown half and half. Whereas you look around and the landscape shows, people speaking about production and challenges around production, citing the virus and other reasons. Trinity's production, both in a local scale and from a more international landscape, is up, which is something that we credit the operational team largely for, and has been one of the key foundations for the P&L. Looking across at the P&L, of course, the oil price year and half and half down by 40%. Revenues are down, and as a result, adjusted EBITDA down. But those are price driven. If you look at the controllable areas within the P&L, namely the operating costs and the administrative costs, those are both down. And that's in line with the description that we said to the market in Q1, where we said, our aim this year to be financially resilient would be to take the break even for 2020 specifically down to $20.50. So we started off the year, the first quarter, at around $26. And by the half year, we've taken that down to $22.30. And the direction of travel is to take that down even further into Q3 and Q4, thus enabling us to have an annual average of $20.50. Cash balance has grown nicely, which we will look into a little bit later on in a couple of slides. But the important thing here is that the P&L that supports the balance sheet is still turning out positive operational cash flow, and the balance sheet is strengthening. Production is strong. Our guidance remains unchanged for the year, so between 31 to 3,300, which is growth on the back of 2019 without actually drilling any wells during the course of 2020. We continue to focus on partnering for growth at a strategic level, but also at an operational level alongside our contractors and the supply chain. And as Bruce mentioned, the last 4.5 years of this business being consistent, both in terms of production, break-evens, managing the costs, have allowed us to engender relationships that are beginning to become more short, medium, and then very long-term value-adding relationships. Next slide, please, Bruce. Thanks. Here we dig a little bit into the P&L, and when I mentioned before that the OPEX and the G&A are down, you can see that the percentage changes there for both OPEX and G&A, particularly G&A, are quite healthy. That's driven our ability to have a lower break-even this year alongside the hedging. When we hedged in 2019, the oil price wasn't where it is today, and it certainly we weren't expecting what happened in March, April, and May to happen. And we were hedging against the SPT at that point in time, the Supplementary Petroleum Tax. And we hedged a series of instruments looking across between $50 to $56 to mitigate the impact of SPT. It just so happened that with the oil price dropping out, we managed to put those hedges in place, and the oil price dropping below 50 and even to below sort of $20 and $30, we've managed to be able to reap the rewards of those hedges rather fortuitously. Going forward into 2021, we'll continue to hedge, and hedging remains a strong pillar of the financial strategy that we have. But the hedging now is focused more to low oil prices. So we've taken out put spreads, which essentially cover us between $20 to $30 and buffer the cash flows in the event that the oil price would become downwardly volatile. In terms of the break-even analysis down below in the bar graphs, I think what we were just trying to clearly illustrate here is that the operating break-even is impacted by the hedging that I just mentioned before. During the course of this year, those hedges are going to likely bring in to the tune cash flow of around $2 million US, just to give you an idea of the scale of what the hedging income will be. Next slide, please. We've inserted a slide to describe the cash flow and the resulting impact on the balance sheet here. Because this year, the cash balance moved from $13.8 million at the end of the year to $19.7 million at the half year. So a large movement, largely attributable to two, I would say, one-off movements, which would be the overdraft facility that we drew down on April the 1st. We drew down on that at that point in time, the uncertainty and the volatility that we were seeing at that point in time. We thought it was more prudent to have the cash on our balance sheet than to leave the cash in, as a potential. So we drew down on that through the discussion with the bank, described what we've done to the business in terms of financial resilience. It was really sort of a precautionary measure. We have not utilized those funds as yet, and those remain on deposit. And the plan is not to utilize those funds going forward, actually. So that was very much a precautionary measure. The interest rate on that is very low. Over the course of this year, it'll be less than $20,000 in interest that we'll be paying on that. So it's a very, very low cost instrument that allows us flexibility. What we're actually looking at is looking at that facility and seeing whether we can broaden it to help us with our financial flexibility in the event that we want to do something that may be inorganic. The VAT bonds that we received there of $2.8 million, that again is a one-off. It reflects VAT that we would have put together, or VAT receivables that would have accumulated over the 2018 and 2019 period, where we did some heavy spend in terms of the drilling capex. So when the situation with COVID kicked in, the government quite creatively looked at a means by which they don't have to put cash out now, and they offered people with VAT refunds, significant VAT refunds, bonds in replace for those receivables with them. And those bonds were made in such a way that they were saleable to local financial institutions. So we managed to collect all of the bonds in relation to the outstanding 2019 and prior year periods. We sold those to a local financial institution at par, and that has allowed us to convert what is a receivable to a stronger cash position. Otherwise than that, though, on the left-hand side of that waterfall graph, you can see the operating cash flow of $5.9 million. Some changes in working capital, and that really relates to two main elements within there. One is the payment of quarter 4 SPT, quarter 4 19 SPT that was paid in Q1 of 2020. And then the remainder of the drilling capex that would have been paid in quarter 1 as in relation to quarter 4 and quarter 3 of 2019 for that drilling program. So the underlying operational cash flow is flowing through. The business in terms of cash has grown significantly. When we look at the balance sheet summary on the right-hand side, the net cash has increased by 23% from 13.8 to $17 million. A slight change in gearing, but if you look at oil companies, most oil companies are geared somewhere between 20 to 30%, so we're very low in terms of that. And as I mentioned, with the cash balance that we have, we don't intend to utilize that facility. So the gearing is certainly something that we are very comfortable with as a board and management. The current ratio is the one that stands out to me. So the current ratio has improved again from 2.5 to 3.1, basically saying that your current assets outstrip your current liabilities by roughly 3 times. And that, in my view, shows the liquid ability of the company to be able to move quickly to grow the business should we so wish. And as Bruce mentioned, it is about scale and relevance at this moment. So having that cash and having the ability to move quickly on that is an important part of our strategy right now. Next slide, please. Just moving away from the results and focusing on an internal initiative that we're looking at. Most of you who have been following us for some time will be familiar with this story out in the East Coast in the Galeota license, where we have the Trinitys asset that's producing around 1,200 barrels a day. But around 3 years ago, the asset was doing maybe around between 950 to 1,000 barrels a day. And by taking a deep dive into every factor affecting production, we've managed to look at a number of ways to ameliorate that. And whilst we sort of, I would say, organically learned on Trinitys how to move the production volatility from 11% to 2%, making the production a lot less erratic. We did that on a piece-by-piece basis. We've now learned that we can bundle that and take those learnings and actually apply it. What we intend to do is apply it on the WD-56 field, which sits onshore and is our largest producing asset onshore. It does around 1,100 barrels. So we're going to automate 31 wells onshore, which comprise around half of the well stock in that particular asset, but those wells actually make up around 85% of the production within the field. The automation there is the headline grabber, certainly, but the automation is really the catalyst for a change in the operational philosophy. The operational philosophy is designed really to do 2 things. One, reduce the production volatility and bring forward the production into closer and introduce those into, reduce the production volatility so that you actually sell more in a given period of time than you would have if the production volatility was higher. So we're attacking the top line in terms of production, which will change your revenue. And we're also attacking the operating costs, which we've been, as you all know, we've been pretty lean and we've been breaking even for sub 30 for 4.5 years. What we're trying to do now is implement a tool and a technique that we've seen work on Trinitys that's taken operating costs on Trinitys from down by 40%. And a key driver within there has been workovers. Workovers have reduced by 50% between 2018 coming into 2019 and 2020. WD-56 is one of the greatest expenditures we have there in terms of operating costs, is workovers, and we are trying to move from a reactive means to a proactive measure on the WD-56, similar to what we do in the Trinidad field. So the automation will, in essence, allow us to capture data on a more real-time basis, as opposed to a manual, very, very sporadic basis right now. So, for example, a key well that we may look at, we will look at that at best maybe once a fortnight, once a week, when we go and observe what is happening with the fluids, observe the pump or the artificial lift system that's being used. The automation now changes that from once a fortnight or once a week to once every 10 seconds. So therefore, you're able to gather data a lot more quickly. And every 13 minutes, it puts that data together and determines whether the artificial lift system that you're using, whether it is a PCP pump or whether it is a nodding donkey that you typically tend to see, whether that's operating within the parameters that we expect it to be. And if not, it then alerts one of our engineers, and our engineers then would look at that and ascertain, something is out of what we expect. Let's ask the operating team to go take a look, give us some more information about what's to hand, and then we perhaps focus on, we are seeing a challenge, downhole conditions have changed, let us adapt to suit, let us prevent the failure from happening before it actually happens. And what typically happens now is that we don't understand what is happening, a well fails, and then it takes us between 2 to 3 weeks to get the well back onto production. So that is your volatility. If you're now able to curb that and perhaps even extend the life of your pumps, you've done two things. You've reduced your operating costs because you're no longer changing your pumps out as often, and you also now kept your production going for a longer period. So you have stability in both areas. The end result of that, if you look at the bubble in the middle, is an increase in cash flow, free cash flow from the asset by 16%, and an increase in your 1P reserves because you've now brought forward production into a shorter period of time by 17%. So we looked at that over a 10-year period, a long period, but because we are encouraged by what we've seen on Trinidad, and we have done that in-house, compared that to case studies and benchmarked what we've seen on onshore US, and we're working with similar providers for that, we're confident that this is going to be something that is game-changing for us, certainly from how we operate the WD-56 field, but it also offers us the opportunity to look at how would we formulate a new operational philosophy for the field that can be repeatable to other of our fields, but also scalable in the event that we want to continue to grow and become the leading onshore operator and get more scientific with our manufacturing process, which is the onshore operation. With that, I'll hand over to Bruce.
Thanks, Jeremy. Also, this whole drive to automation has been a fantastic shot in the arm for everybody in the company. I think I mentioned that last time. During these COVID times, it's a project we've managed to move ahead pretty quickly and got board approval yesterday to move it forward, to upscale it, as we said, in WD-56 to a whole production unit that will be automated pretty quickly. So it's very exciting for everybody internally as well. This next slide really sets to illustrate the core assets, what they are, if you like, what we currently book and what they look like. So onshore, we do just over 1,800 barrels a day, and we got a pretty conservative reserve base of 7.4 million on 2P and a relatively small 2C number. We are still very conservative in our booking. We still book by wells, not by kind of geography. But with the imminent arrival of the 3D data set, I know you've heard me say that a few times before, but really we have one more turn on legal document. Everything else is done. We will be able to build a three-dimensional geography in the subsurface of our onshore assets. So I believe we will be able to start to book a lot more reserves and then monetize them through high-angle wells and through using the 3D data set. And we think the current assets have got a pretty good chance of getting to over 3,000 barrels a day indicative potential. No time frame on that, but that's what they could ultimately produce. On the west coast, we haven't talked about that for quite a long time, although we do have profitable production over there, about 240 barrels a day. And with this Jubilee initiative that's a public process, it's made us go back and look at that area again in a bit of detail. So we believe that, we know the northern part of the Point Lagura block, we call it the ALM, which is Antilles Land Marine area, has a discovery that was drilled when I was chief executive of Venture a long time ago. It was a discovery, And actually, we have 2C reserves there of 3.2 million barrels, which we've never booked. But in the intervening period, Heritage Petron have drilled 2 horizontals in that area that came in at over 1,000 barrels a day. So it's not unreasonable to say 2,000 barrels a day from those units. This, should we be lucky enough to win Jubilee, the ALM22 development, I think, would become part of that process. On the East Coast, I'll go into it in a bit more detail in a second. Obviously, we've got very strong 2C resources. We need the economic plan in place to put them to 2P, and then the development to turn them into cash. We have a bunch of works going on that, which I'll go on to in a couple of slides' time. But we're seeing a productivity uplift in some of our deeper sands and the modelling that's going on. So we now need to go back and look at the prospectivity of areas where wells have been drilled in the past, and look at the reserves we've got there and what the potential recoverable reserves might be on those. But the themes you see across the assets is reserves upgrades and 3D data. I've been at this quite a while, and particularly in Trinidad, and many of these areas didn't have 3D data before, and you really need 3-dimensional data, good data, to be able to confidently book your reserves and confidently then go and exploit them. So lots of good work going on that. Just a little bit more detail on those areas, though. Onshore on the West Coast, onshore, we are just started negotiating for the new licenses. So we've had the first pass back from them and to them on licenses. So that's ongoing. SPT reform, everybody asks about this. Obviously, it is very important to us, or could be. I've got to be confirmed. I think most of you will know that in the general election, which took place last month, the incoming party, who got re-elected, the PNM, did say that they would reform SPT and kick it upstairs such that it kicks in at $75, not $50. We said, well, that's fine, but we need longer than 2 years in order to take our investments forward. So we do lobby ourselves, but we also lobby through the Energy Chamber. They have the direct line into the Minister of Finance right now. So we'll see what that does in October. We've talked about the accelerated automation for 23 U2 1 well systems and 5/6. That's a very exciting development for us. Now, the 3D volumes you can see on the map on the right shows how they lie. It's 37 square kilometers of data on the surface, but it's a cube of information. We're now beginning to look at, we might reprocess it. It does come processed, but we'll see there might be some attribute analysis that we can carry out on that data when we get into it. But we really feel it's very important. In Trinidad, no one's really looked at this data in any detail to look at how the basin filled and then how the structural geology came along, so we can better understand it. And that will then, the next line, begin to high-grade a new play development on a regional scale. We have some ideas, but the seismic is going to start to point us, and we also have regional seismic data in there, point us to where we might look for new plays. They're either deeper traditional targets or new plays. Obviously, Touchstone have had success not far away to the east from wells that were drilled in the 50s by Shell. So there's a splattering of wells all over the island that go deeper that can bring to light perhaps further opportunity. On the West Coast, I've talked about the ALM22 discovery that's currently not booked, that would probably become part of Jubilee. We also have that Brighton, the ABN 151 well, which is the last well that Venture drilled, which is a flowing well, but it's currently shut in, needing a workover that could contribute to 175 barrels of oil a day flowing. It also produces a fair bit of gas, and as part of our ESG push and part of becoming more efficient and a better operator, we are looking on a fair long way down, looking at technologies that can turn that gas, stranded gas, into compressed natural gas to put into combustion engines to lower particulate emissions and lower CO2 emissions, and also to look at perhaps putting it into LNG to move it a bit further through the island and to other islands. So that's all progressing pretty well on the West Coast. I've talked about that. So these international partnerships that we're beginning to talk about, obviously I'll go on to talk about Cairn in a minute, but we also have technology and engineering ones. And we will, as we go through the next 2 or 3 months, we're going to have a series of announcements and a series of these partnerships as part of the business that we'll describe that we're developing. And that does several things. We're still quite a small oil company the way the world goes, but I think we're considered, high quality, even though we're small. So very big organizations are willing to partner with us. Obviously, we have a much strengthened balance sheet than we used to, but it does several things, particularly on the technology and engineering side. It enables us to assess opportunity better, utilizing their skills that we don't have in-house. And many oil companies don't have their skills. And also, it enables you to then put forward a differentiated new business partnership to the regulator or to Heritage or whoever else. And then it enables you to deliver on it because you've done a lot of the front-end engineering, a lot of the design work, a lot of the completion work, a lot of the drilling work. You're then able to de-risk delivering on your promise. So developing inventory and building best-in-class partnerships is very important, and you'll see that right across our business over the next few months. This slide goes on to show East Galeota on the East Coast. So again, a lot of work going on in the background, particularly the new framework. So within that new framework is a new license, a 25-year license. So when that's signed, T is 0, which is very important. We're negotiating a new crude offtake and sales agreement, and we're currently 35% in our favor with Heritage outside of the Trinidad production area. We will look at rationalizing that ownership structure as we move forward. So a lot of commercial work and a lot of negotiation going on, but that's all progressing pretty well. We've described before, we do have partnerships in place here. So the top sides, the flow lines, the wellheads, the electrical umbilicals, etc., have been worked up to a point with an international operator, a very large, well-known international operator, a technology operator. So we will, again, when we're ready, when we've got the frameworks largely in place, we'll start to talk about those in more detail. But in the background, we are continuing to work. So we're kind of in the pre-feed, feed part of eco development. And the very important bit to go into that is the last bit of reservoir modeling we're doing in Aberdeen with Axis. So before, we've had pretty much static models. We calculate just mathematically in-place numbers and mathematically what we think flow rates and then reserves would be. This is a three-dimensional cube and set of cells that has developed right across all the sands in as much detail as we possibly can to then model on a probabilistic basis how wells would perform. That's gone into its last iteration this week in a couple of weeks work to actually fine-tune the location of those wells. We're seeing positive results from that work, which is great. That then, assuming that work pans out, then we've got to look at the other prospects and say, right, if we think the flow rates from these wells is going to be 3x, well, what are we going to do about exploiting those reserves and bringing them to town? And all the work we've done on TGAL, the Echo platform, is cut and paste to TGAL Northeast or to Southwest Trinidad, and both those two I mentioned, the two of them have got 100 million barrels in place. So there is some risk associated with them, but we've got to mitigate that through ultimately an appraisal well in each of them and inputting our new models on reservoirs. But in the background, geotechnical and pipeline survey work will be kicking off pretty soon. And also the environmental studies are underway to get our certificate of environmental clearance, our CECs, which is for the entire project, and onshore studies as well for our tank farm. So a lot going on there. We've never really laid timelines out, but we're looking to get FDP and FID approvals next year. I'm being quite vague on the timelines, but that's kind of our aim. And we will look for a farm down option in the first half of next year. But what we're doing here, I hope you can see, is it's not just Trinitest and its automation and infill wells there. It's not just TGAL and Echo, but it's also TGAL Northeast and Trinitest. So we can attract companies in that it's about current production, it's about near-term development, it's about further development, which is largely a cut and paste in terms of topsides and engineering to bring those on. So a very nice chain of daisies to string together. And we're currently in our plan looking at Echo First Oil first half 2023. So a lot to play for on that asset, but a lot of work going on. The next slide here is new business. Now we're talking about this in more detail than we've done before, because I think we have made the case pretty well for the financial performance of the business and our current performance and our current assets. So the pathway in front of us is becoming much better defined as a management team and as a board about what we're doing. So the Jubilee bid was a public bid from Heritage. It's in the north. It's in the offshore west coast. It overlaps, as I said, onto our Point Laguna license. It's an asset that currently does 3,800 barrels a day, but its in-place number is 1 billion barrels, which is an enormous number. Some of that is heavier oil, which will be difficult, but they currently carry 14 million of proven in the Jubilee well area, which sits between two production clusters. So it's a bit of production, it's redevelopment, and it's greenfield. So that's right up our street. But it's a big piece of business. So Cairn Energy, we know very well. Some of you might remember, but in 2013, we took Cairn to Trinidad and we bid on a deep water block, us as the minority partner, but we introduced them to Trinidad and the geology and the regulator. And I went down there with the Cairn CEO and introduced him to all the major government officials. And we bid on a license that we lost to, we think we came second actually to BHP. They've subsequently drilled that and found over 4 TCF of gas. And actually, I just read today they're going to deepen that a well on that prospect, looking for deeper oil. So they've always liked Trinidad. They you know, the low risk, long life development story off the west coast. They like. That's also then led us to. So just before I go on to the next one, so the expressions of interest were submitted. I don't know how many companies submitted, but when we were on a call on this 4 or 5 months ago, there were 95 companies listening in. I don't know how many have got through to the request for proposals, but I should think it will be, you know, single-digit numbers because it's just difficult to manage. A data room will open up, hopefully in the next few weeks, and then I would imagine the guidance we're getting is that they'll want proposals in sometime by the end of the year for a decision in the first quarter, and then, you know, negotiate farm out agreements and licenses and things. So that's where we're ready to go. So why are Cairn with us? Well, we've got knowledge on the ground. We've got great regional geological experience. I worked on the deep onshore in the late 80s with Lasmo on an onshore bid with Total, but actually Exxon won in the end. And we've always been looking at that. Ryan Ramsuk, Dr. Ramsuk, our head of subsurface, is a great regional geologist. So I think Cairn have seen what we can bring. Also, our operating mantra and our automation, I think, is the way that you'd go about running these sorts of assets. Cairn bring, obviously, a very broad, deep balance sheet and a great resource. They have in Edinburgh a large engineering subsurface team, new business team. So we see it as very symbiotic, I guess. The next one down is the Northwest District bid. So this came out a couple of months ago, inviting people to bid for exploration below known production, kind of, as it were. We call it, you know, the pre-tertiary, the Cretaceous, over the southwest part of Trinidad. Again, I had worked on this a long time ago in my career, and Ryan has worked as well within the university and outside on these plays. And in Trinidad, there are, into the Cretaceous, I think it's 15 penetrations. Now, Cairn, as you all know, opened up Senegal. They recently sold their position there, and they have, on the conjugate play, the other side of the Atlantic, they have the biggest position in Suriname, a 13,000 square kilometer license. So if you think of the coastline of Suriname up into Guyana and onto Trinidad, that pretty much represents the Cretaceous coastline, because the rocks are very old in the hinterland. It's a cratonic plate, so that really hasn't changed much. So you come out of Guyana, the northern end of Guyana, which is only, you know, 100 or so K from Trinidad. You go into the Columbus Basin, which is very deep. The next place that you can access the Cretaceous with the drill bit is Trinidad, because it's been uplifted and the shallow sediments have been eroded. On one of our licenses, 60-odd thousand barrels of oil was produced from the Cretaceous in the late 50s, early 60s. And there's been penetrations over the last 40, 50 years that penetrated slope fans and fans out on the flat, out in the basin. So they bring huge amount of experience there. Obviously, we know how to operate onshore, we know how logistics work onshore, and our regional knowledge is pretty good. Again, it's something that made sense that we joined together on that. So we're just at that early stage where expressions of interest have been submitted. I think it's going to be pretty competitive. I think the biggest companies in the world will be expressing interest on that. But I think us being the local content is very important these days in developing countries. Will count for a lot of points actually in our bid. So the digging up of some of our regional data, and Ryan and myself and his team and some of our other contractors working on preparing data for care and presentations, etc., started to look at new geological plays, not just pre-Cretaceous, but other ones. So we're now internally generating some other ideas, just ourselves at the minute, which are pretty exciting, that are some brand new plays that nobody's thought about, which are more gas prone, and some other plays that are more traditional. I talked about ESG. We're one of the few companies actually measuring carbon output for about 3 years in Trinidad. Not many others do. But on our drive to build a new type of platform at Echo, actually using power from shore, no generators offshore, no big pumps needing fuel offshore. We kind of designed the lowest carbon footprint platform in Trinidad, and actually would rank anywhere in the world. And that's got us thinking, right, okay, if we could put green electricity into that platform, we're reducing the output and the unit carbon produced. Take carbon units that it's taken to deliver every barrel of oil or gas to shore, which is, I think, a metric that's going to become much more and more important, actually, even on pricing fuels. So that's had us look at stranded gas. I talked about it a bit at Brighton and other parts of our asset where we can make CNG or even LNG from it to power our own assets, but others as well. And we're a fair bit down there, obviously with the technology, but also speaking to the local regulators about how we can go ahead and do that. And that drives the efficiencies into our business, which is hugely important. So we've now got quite a range of opportunities, as I say at the bottom, from traditional stuff through to competitive bids, but all within a pretty tight frame. Most of these things here will play out in the next 3 to 6 months at least. So an exciting time lies ahead, layered upon our continuous work on our current assets and automation makes for an exciting time. So the last slide here really is just a summary of what I'm saying. We're really looking for relevance. We're looking for really meaningful, high-quality partners, which I think we're beginning to demonstrate we can bring to help us assess targets, help us win targets, and help us deliver on those assets. There are both internal and external opportunities within the business as well that we're working on hard. So we, as Jeremy mentioned, will staff up a little bit on subsurface. Edouard, who's our new CFO, is listening to this presentation. He just joined us on Monday. That's to give Jeremy the space and the time to work with me much more strategically on new business and developing our relationship base in Trinidad. So I think, without going through all the bullet points, we present a very differentiated offering going forward, and a lot of stuff going on in the next 3 to 6 months. But always remembering we've got to protect our base production and progress Echo as well to deliver our internal growth as much as the external one. So at that point, I think we're going to pause.
That's great. Bruce, Jeremy, thank you very much indeed for updating investors there. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated on the right-hand side of your screen. But just while the company take a few moments to review those investor questions submitted already, I'd like to remind you that recording this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard on the Investor Meet Company platform. Lastly, before I hand back to Bruce and Jeremy, I'd like to remind you that your feedback is important to the company. Immediately after this presentation is ended, you will be redirected for the opportunity to provide feedback in order that the company can better understand your views and expectations. Bruce, Jeremy, perhaps before we look at some of the questions submitted today, we did have a number of questions pre-submitted by investors, so much so that I think we sort of polarized around a number of themes. Perhaps if you could give a little bit more colour on each, that would be fantastic. I know you have covered Galeota, but that was one of the first areas there in your progress. The second being drilling, what you're doing there. Third, being seismic, and also new business opportunities and initiatives. If we could perhaps start with Galeota, if that's possible.
Yeah, hi, everybody. Jeremy, do you want to have a first part on Galeota?
Yep, sure. I guess coming back to what Bruce mentioned on the slide of Galeota, the project itself, we have been working on it in the background, and it's been a very encouraging set of, I guess, feedback so far. The subsurface work that we're doing, the dynamic modeling being done by Axis, who is one of the world-class providers of dynamic modeling. By putting our data into that and reworking the model and creating from a static to dynamic model, the results that we've seen have helped us learn a lot, and it's taken our subsurface team, up in terms of their sophistication as well. So we've learned from there. The results are encouraging. We're working together with a facilities provider who is, again, a world-class leader in what they do, and the solutions that they can offer us and they are offering us, in terms of the platform, the subsea power cables, the pipeline, all of these things are leading towards, a lesser carbon intense mining exercise that we will do there. The next step that we want to look at is look at the onshore facilities and the ability for those to be able to take the new crude in and be able to export that as smoothly as possible. And the other key elements of the project, we're going to look at are the drilling contract. Alongside all of this, the project team is working assiduously to ensure that we have the various licenses, the permissions in place to be able to do what we intend to do. The key one being the environmental. So we've done environmental studies, and in the next fortnight, actually, we'll be commencing a bathymetry and a pipeline survey that will be key not only for the environmental, but also key for guiding us in terms of the pipeline engineering. So a lot of ways that the project is moving forward, and why we felt a bit stronger now to come out and say that the Galeota license, and we always focus on this ECHO platform, which was developing the reserves that the Teagal well discovered. But as we look at the Galeota license and look across that anticline that's shown in the picture here, we've seen that the prospectivity and the more work that we do is increasing our understanding and our the value that we see in Galeota. So aside from the ECHO platform, the infill drilling around Trinidad, the prospectivity around the northeast of the Teagal area and the southwest are areas that we think can unlock further reserves and resources that we can monetize in due course. And we think when you put all of those things together, it's a pretty cogent description of a license that can be very value adding and very material for another player to help us de-risk that development in due course.
Fantastic. Thank you very much, Jeremy. I guess the next two we've got really the themes that came through. It was drilling and seismic. If I guess want to take those two together, perhaps.
Yeah, Jeremy, as you're on that team, do you want to talk to the new delivery team and the challenges and how we go about challenging ourselves internally and putting teams together like that?
Yeah, certainly, Bruce. I think when we resumed drilling in 2018 and then we continued into 2019, a total of 14 wells over those couple of years, and it made us the most active driller in Trinidad, bar none, inclusive of the international oil companies. The team that drilled those wells drilled them effectively. They drilled every single well on or below budget, inclusive of completions. So that aspect of it we were very confident of, and it led us into a 2019 program where we thought, why don't we try and add another tool into the toolkit, and that was the high angle well. And we drilled that well. It was drilled on time. We accessed the reservoirs anticipated. The results were very encouraging. And what the high angle well does for us is it's technically perhaps better in terms of how you manage your reservoir. But more importantly, and from my perspective, the economics are better in terms of proportionally in comparison to a low angle well. So by being able to master that technique, so we would drill one, we always said that it'll take us, a few tries to get that and perfect it like the low angle wells. And the intent is to continue working on the high angle wells. What it does is, if we can get that technique to a point where we're very confident about it, and that's now become part of our regular menu of what we can deliver on, it then allows Trinity to drill at even lower oil prices. And it allows us to deploy CapEx to continue to grow production, support the P&L, which eventually supports the balance sheet. So the focus for this year was, we faced a pretty unusual set of circumstances, a lot of volatility. And as Bruce mentioned, we are about to renegotiate the land licenses. The plan is not to drill between now and the year end. Once the licenses are renewed, we have a little bit more certainty with what is happening in the macro environment, both from a fiscal regime standpoint and an oil environment as well. I think the intent, certainly the board is very encouraging for us drilling another high angle well during half one of next year. So that is, I guess, the drilling aspect of it. The onshore seismic, I think in June of 2018, Bruce and I were out, speaking about that, and we've now moved along 2 years, and it is. I would say, we've had discussions with Heritage. We've looked at the data. We have an agreement in front of us. As with everything, we want to make sure that that agreement gives us the best opportunity to be able to utilize the seismic data. So we're working through with Heritage to make sure that the agreement is mutually agreeable, and hopefully we'll soon have the seismic across in our data banks, and we can make use of that to help de-risk further drilling in terms of high angle well drilling, traditional wells, but also some of the plays that Bruce mentioned geologically.
Yeah, I think the seismic, when we can start to build proper three-dimensional models across our license areas, we have an ability, obviously, to book greater reserves, because we're not just booking, a radius around a well. We're booking the areas in between. But more importantly, it allows us to, without simply using well control data, which is what we've had to do today, we can see in 3 dimensions in the subsurface the orientation of the geology, of the beds, and hopefully of the sand bodies. And with that, then we can really start to, with the high angle wells, rather than kind of randomly drift them through the sand bodies, we should be able to geosteer the wells down the axis of the sand bodies, which is, what you do in the world. And in a more mature basin, in terms of horizontal drilling, we said at the beginning of this, it would take, 4, 5, 6 wells to get it right. We in the first well, we drilled it really well, we cemented it, we logged it. Of course, this is at a very high angle, so gravity is not working in your favor. We got initial production that wasn't far off what we expected. We have then, subsequently to that, encountered a lot of sand production. We knew that would be a risk in this area, but the first experiment was run in this more sand-prone area because of the well control, because we didn't have the seismic. So by going ahead and drilling this well, we needed close well control, which meant that those reservoirs in those areas were perhaps a bit more depleted and therefore a bit more prone to sand. But where we're now looking is in much deeper areas, so not 3,500 feet, but over 6,000 feet, where the rocks are deeper and therefore more consolidated, and sand is prognosed to be less of an issue. And also, earlier than we did last time, we will run sand screens and gravel pat these wells probably earlier on. So that's just part of our learning as we take this forward. But as Jeremy said, we had a board meeting yesterday, and the board were very keen to progress the high angle well drilling initiative that we've described. But as Jeremy said, there's some certain gates we've got to go through with Heritage on new licenses. There's no sense in going and committing to work program now you're not going to get credit for, and your new licenses going forward, kind of bottom line. But the seismic's really important, and very importantly, seismics, we have to have the right people. So the gentleman who will be interpreting that data worked in Venezuela for about 4 or 5 years on very similar systems, slightly older rocks, and has great experience of working onshore 3D in these sorts of environments. So we're looking forward to him. He's the gentleman that did the interpretation of a Galeota as well, so he's pretty tuned in to Trinidad. So you have to have the right pilot to fly the data to chase down, what you're going to do. So we're pretty, looking forward to that very much indeed, actually.
Fantastic, thank you, Bruce. We did have one further thing, which was sort of new business initiatives, and I'm just kind of conscious of time as well. We've had a number of live questions in. If you get a moment just to perhaps run through that, and we can just add some of the live questions post that.
Yeah, I mean, I've hopefully hit the high points. I think we're looking to punch above our weight here and get into some really good assets by partnering with Cairn. And I think going in with local companies is very important in the world. And I think we're a UK registered company, but by all intents and purposes, we're Trinidadian and thought of as Trinidadian in Trinidad, and that's actually very important to the Ministry of Energy, the Ministry of Finance, and in fact to the Prime Minister's office. So I think that's just the right way to do it. And Cairn have a huge new business unit, and look at deals, daily, weekly across the globe. So they will be, a great partner, particularly in the Jubilee one initially, and hopefully if we get through to the second bit in the Northwest District bid. The internally generated ones are very interesting. Ryan is a lecturer, senior lecturer at the University of the West Indies, and I was an exploration manager director for half of my career. So between the two of us, we're beginning to see some promising things. The underlying point of Trinidad is that it's a unique petroleum province. It's what we would call supercharged. So there has been more oil and gas generated than there is ability for the Earth's crust to trap it. And that's the official de Maison classification for this basin. So that's why we have mud volcanoes. That's why we have seeps onshore, seeps offshore. That's why we've got the pitch lake, because the Earth can't contain the hydrocarbons that have been generated. So therefore, we know we've got reservoirs. We just need to find the right traps. So therefore, it is you don't worry about migration. You don't worry about oil or gas being generated, the source rock. You just got to look for traps, and that's what we're doing in areas that really haven't been looked at before. So that's but I didn't really mention the bottom was acquisitions. We do look at areas that we bolt on that we like. I think, though, because licenses are being renewed onshore, those sorts of deals are subject to licenses being renewed. So we are still looking at other opportunities, but they'll be more bolt-on. But we, as a business, we're kind of bifurcating almost. We've got the ongoing bit, the automation bit, the reservoir engineering bit, the reservoir geology bit, and then the new business bit, with myself and Ryan, and now Jeremy be able to free up more time in that as well. When you nail that to strong balance sheet and cash, and then international partners of high quality, I hope we'll be able to take the company somewhere quickly that is relevant to us all.
Fantastic. I think it's a good point to end there, Bruce. If I could perhaps ask you just to turn to some of the live Q&A, and I haven't given you perhaps a great amount of time, guys, just to run through it. But if you could just scan through and just say the name of who's asked the question, read out the question, give your answers where appropriate to do so.
So, Paul,
I've seen a couple I've been given.
Please go ahead, Joe.
Sorry, Bruce. I was just saying, I saw a couple there from an Alex S. in relation to hedging the 15% of oil production. The question is, could you also discuss in more detail how the decision was made to hedge 15% of oil production going forward? Alex, interesting question, because hedging itself, is quite speculative, and it is buying insurance for downside oil price volatility. So what we've done, as we mentioned in 2019, we looked at the oil price and we thought we want to deploy capex and we want to mitigate the impact of SVT. Now where the oil price is, we're actually looking at hedging downside protection. So we've hedged between $20 to $30. The 15% or 16% oil that you're seeing going in to 2021 is the first layer of hedging that we intend to put into play for 2021. But based on the production alongside the investment profile that we want to contemplate for 2021, we might be looking to increase the hedging up to somewhere between the vicinity of, I would say, 30 to 35% to give us comfort that in low oil price scenarios, we still have the ability to continue investing and keep some stability in terms of the investment profile, the production, and the new business opportunities. There's another right below that from Charles M. It says, how much further can SGA costs be cut? Or have you reached the end of the line as you go on the offensive with the drill bit? I think it's a question. I mean, we can certainly dig deeper and change costs, but costs are, we tend to look at costs as one aspect, but it's really about value. And what value are you trying to derive in the short and medium term? What we did this year was not have to slash and burn, but we refined the business model to make it more flexible and resilient to a low or an uncertain set of oil price dynamics in terms of particularly demand as influenced by the pandemic. And what we've seen is the oil demand and some of the fundamentals seem to have reached a point of stability, and all the outlooks for the oil price seem to be less volatile. So what we focus on is, as ever, making sure that we can be flexible as a business, but also where we've taken the business to this year to break even at $20.50 is not the intended medium to long-term break even of this business. The medium long-term break even of this business is always intended to be sub $30. We've been well below that for the last 4.5 years. This year, we intend to achieve $20.50 with the help of the hedging that we fortuitously put into place in 2019. But I would say that the costs and the break-even that we'll get back to would see us in or around $26, $27 in the near future. And as we grow production meaningfully, and the step changes that Bruce is talking to, those will drop. But based on this current platform, I would say we'll be in or around $26 to $27.
There was just one more that was brought to my attention on SPT and why this time. We're not politicians, but in my memory, which is quite long in Trinidad, it's the first time I've seen a manifesto on both sides of the House that promised change to SPT. The first time I've seen that. So let's just see how that runs out. Thanks, Paul.
Yeah, I was going to say, just kind of conscious of time. I think you've run through those questions, and I would like to remind investors that all questions submitted today will be reviewed by the company, and submitted answers where appropriate to do so. So I'd like to say thank you to Bruce and Jeremy for updating investors today. Could I ask investors not to close the session? You'll now be automatically redirected for the opportunity to provide your feedback. If you access the meeting through the website itself, the feedback form will appear in front of you. If you access it via the link from the email, you will be asked to log in and just fill that in. It just takes a couple of minutes and is much appreciated by the company. So on behalf of Trinity Exploration Production, we'd like to thank you for attending today's presentation. This concludes today's meeting. Thank you very much indeed.